all the participants to this unique workshop on income tax return, as we are right in the season for filing our taxes, and it will come with its complexities, right from uploading the returns to checking how they are getting processed, which is another big issue which we should be taking up today. So with me, Utsav Hirani, Chairman of Direct Tax Committee, Mayur Modha, the Secretary of CA Association, and Jay, the Convener of Direct Tax Committee. So we all welcome you. Divya, the CA Divya Jokhakar, she's with us. She's from Bombay. So we've already done a 12 series online direct webinars on direct taxes, and we had almost more than 600 participants across India. We are also doing our indirect tax study group. So over here, if people want to join, we have an indirect tax study group and a brain trust, which will be on 8th of July. But right now, I think we should start this seminar and focus on the issues at hand. And I would like Utsav to please take the introduction and the seminar ahead. Thank you.
Yeah. So I welcome Divya for this particular lecture meeting. Divya is a qualified chartered accountant, and she is partner with BD Jokhakar since more than a decade now. And she specializes in income tax and international tax. She has also helped in publications of various publications. I won't take much time to introduce Divya because since the topic is very wide, I will hand over the stage to Divya now. Divya, you can start the proceedings of the seminar. Yeah, of the webinar. Yeah. Divya.
Is there some connection issue, Utsav?
Okay. Can you hear me now? Are you able to hear me, Shivang bhai?
Yes, Divya, you are audible.
Yes, Divya, we are able to hear you.
Yeah, because I joined.
And one thing, thank you for giving me a chance to speak once again. I forgot to wish Happy CA Day to all of you. And
Happy CA Day to you too.
Thank you. And we've always been having. I think Divya, this is your first seminar with the association, right? We've been always.
Yes, with Ahmedabad, yes, absolutely.
Speakers from BCAS, so we are happy to welcome you too.
Yes, thank you so much. Happy CA Day to everyone. I hope you can see me clearly, hear me clearly. If there is at all a disturbance, Utsav will nudge me in between. Presently, I'm beginning my slideshow with filing of income tax return for assessment year 23-24. There is an error on my first slide that I would not like to make in my returns, which is 24-25. But do not worry, I'm well prepared for this session. Going forward, what we are going to do is we are going to see due dates for assessment year 23-24, the types of ITR, changes that have taken place in this year, the applicability of non-residents, what kind of ITRs do not apply to them mainly, the important schedules in the return of income, and we will be specially focusing mainly on ITR 7 because ITR 6 does not have much changes. We will see what is a revised, belated, and updated ITR. And special points from my end and keys to crack this ITR. I have a small poem for everyone. It says you audit, you compute, you prepare for TDS and GST, you incorporate, you close down, and whatever you do, you have to file the return. Once you begin filing, you cannot turn. When you e-file, the sections and the rules that you learn, you and the midnight lamp's oil will continue to burn. What are the rules you must be aware of before filing the return of income? Mainly Rule 12, which speaks about how to file the return of income, what form is applicable for different kind of assessee, what is the scheme of e-verification while you're uploading the return, post the upload of the return, while you're uploading tax audits, while you're uploading the MAT reports, and while you're uploading transfer pricing reports or any other. Rule 128 talks about tax credit for foreign countries withholding of taxes that you want to claim as a resident of India. Rule 115 explains what is the way in which you will compute your foreign source income in Schedule FSI and also claim the tax credit of the foreign country, which is in Schedule TR of the ITR. This rule explains that you need to compute your specific income by taking the SBI TT buying rate 1 month before the end of the month in which the income is accrued or arisen to you. So let us have received a dividend on 15th of April or 15th of May, let's suppose. I would take 30th April TT buying SBI, State Bank of India rate on that day. If that rate is not available on the 30th of April, you go a day prior, that is the 29th of April. This rule is very small, very succinct, and it is very easy to understand. Rule 37BA, it tells you how in Schedule TDS and your 26AS, if there is any kind of a TDS that the other person needs to claim from your 26AS, or you need to claim that TDS from anyone else's 26AS, what is the procedure? That procedure explains that you need to apply as a deductee to the deductor, and the deductor will issue you a certificate. Rule 41 explains that once you have filed the return of income, you can apply to the assessing officer in Form 30 to apply for the refund of income tax. You cannot use this rule and the form for application of refund as long as you have not filed your return of income. The specific due dates, we will be filing starting 31st July 2023 for non-audit case, which is the original return. On the 30th of September 2023, you will be seeing a plethora of due dates. One would be tax audit case, where you will be filing for individuals which are and non-corporates who have tax audits, including any other audits per se. And then you will be filing the Form 3CB. We go one step forward and go to the next slide. We're talking about charitable trust, line number 6 or 7, where we say audit report with charity commissioner. Specifically, I'm talking to an audience in Gujarat and Ahmedabad. I love coming to Ahmedabad because my Nana was staying there. So audit report with charity commissioner for the Gujarat Public Trust Act and the Maharashtra Public Trust Act is applicable for the 30th of September. And within 30 days from that date, you'll have to file it online with the charity commissioner's office. At least I'm aware of the Maharashtra laws, which says that you have to go online and file your financials in scanned copy, which are signed by the auditor and the trustees. And later on, you have to submit that verification page of the charity commissioner with the charity commissioner's office. So what happens after the 30th September is then we have the next due date for the non-corporates who are not applicable to audits or are applicable to audits and have missed out on filing the return. So the belated or late return due date is 31st December. You will not be able to carry forward any losses except unabsorbed depreciation and loss from house property, whereas loss from house property is now restricted up to rupees 2 lakh only. Revised return 31st December. And yes, ITRU, the new animal in the room, which says ITRU under section 139A, and the due date is 2 years from the end of relevant assessment year. We will explain what are updated return, what are the conditions therein as we move forward. 10BD and 10B are statement of donations for those charity trusts which have to file Form 10BD if they are registered under 80G subsection 5 of the Act, that you need to or should have filed before 31st May 2023. And by the same day, you would have to issue 10BE, that is the donation receipts acknowledgement, to your donors. It was ensured by the FM before that same entries would be appearing in your 26 AS, but unfortunately, we recently had a session with e-verification department where the director of income tax informed us that still that thing has to still come into the 26 AS, and we're still awaiting it. Despite the fact you do not have 10BE from your clients, you can still take the deduction for 80G in your computation of income, because there is no provision in the Income Tax Act which says that despite you do not have 10BE, or possibly your trust has not filed 10BD, you cannot claim the deduction. Also, the intimation does not check or e-verify that part along with the trust details or any other details. But yes, while you file Form ITR and you have to fill Section 80G, the details of the trust, the PAN of the trust would be necessary. So it is better you verify that with the trustee's receipt, if not 10BE. Moving forward, ITR 7, which are not applicable to audit under tax, which is 10B and 10BB form, you will have to file the return by 31st of July. This year, there has been one major change while we are talking of charity trust, that the due date has shifted 1 month prior to 2 months prior for Form 9A, which is accumulation for 1 year, and Form 10, which is accumulation for 5 years, where you have to invest your income for the purpose of having application. Moving forward, we have 31st October as Form 10B and 10BB. That means that by 31st August, you will have to necessarily complete your trust audit under any act of the trust, which is Indian Public Trust Act, the Indian Trust Act 1882, or Maharashtra Public Trust Act, or Gujarat Public Trust Act, or Karnataka or Delhi Public Trust Act. Because thereafter is when you will have to know your accumulations, you will have to know your applications, if in any, under Section 11(1)(a) or Section 11(2) of the Act. Utsav, if you can let me know if my speed is okay. Do you want me to go fast or slow? Because now is the form part.
Divya, your speed is fine, but you can. I think it's fine. I think it's fine. You can go. I think it's fine. Yeah.
Okay.
Yeah.
Thank you. Now, on corporates, the tax audit due date will be 30th September, and the company returns will have to be filed by 1 month later, which is 31st October. Now, in case you are applicable to MAT and you're not going for the tax under the normal provisions of the Act, you will have to file your MAT audit report before the 30th of September, and later on, make sure that the details of that MAT audit report are embedded in your ITR 6 before the 31st of October. Similarly, if you're a transfer pricing related entity, you totally shift your gears and you go to tax audit MAT report on 31st of October, and your return filing will be 30th November. Master files for 3CAA and declaration of master file. What do these things mean? If I am an A limited company in India having a subsidiary, being a subsidiary of a holding company, I will have to file master file in India. It's a local file by saying, this is my parent company outside India. This is the ultimate parent company outside India. And here are the details. It has two parts, part A and part B. I will not be going into higher details because it depends on the threshold of the company outside India being your holding company, or reverse, if you are somebody's holding company, and how you need to file this form. In case you have a sister concern in India, let's say I have a parallel sister concern B, who is also having same relations as that of mine with the foreign country. So let's say there is Tata America, Tata India, Mumbai, and Tata Co, Pune. So Tata India takes responsibility to file the declaration of its second subsidiary, Tata Co, Pune, before the 30th of October, and says, look, this is me, this is my sister concern, and this is my ultimate company. holding company, and this is my parent company. And the last part is country by country reporting, where there is also a declaration which has to be filed 2 months prior. But we say the 3C AC is only applicable in case you have a holding company or your foreign parent which has crossed the global threshold of 750 million euros, which I would call it roughly about 6 to 6,500 crores of rupees as per the Indian exchange rate. All right. Now we quickly go through what ITR is applicable for whom. ITR 1 Sahaj is applicable for individual and HUF. If you are a non-resident, RNOR, having agriculture income more than 5,000 rupees or having any house property more than one house property, you cannot file ITR 1. Also, if you're a salary class employee, but you are a director in a private limited company or you hold unlisted shares, you come out of ITR 1. So you go to ITR 2. ITR 2 will only not allow you to file any income under business profession. ITR 3, you can file under business profession even if you're filing income under PGBP using the presumptive taxation. Now, what is the difference between ITR 3 and 4 in that case? ITR 4 is called as Sugam. Your gross total income has to be up to 50 lakh rupees. Your agriculture income should not cross more than 5,000 rupees. You should not be a director in a company and you should not be holding unlisted shares. Any of these conditions apply, you directly jump to ITR 3. Knowing your ITR is very important. ITR 5, partnership firms, LLP, BOI, private trust. I would directly jump to ITR A. Modified return in case of business organization, if there is a tribunal or a high court giving you an order under the Companies Act and the National Company Law Tribunal, which says, look here, you are okay to demerge, merge, reorganize, restructure, then the successor company, whether one company or many resulting companies, which are known as successor companies, under the Rule 12AD of Section 170A of the Act, will have to file a modified return within 6 months from the day of the receipt of the order. Now, ITR A is specifically not released under JSON utility, but ITR U is available. ITR 7 is yet not out. ITR 6 is yet not out as JSON. So we will have to wait for those trusts who are not applicable to any kind of audits, whether under the Charity Act or under the Income Tax Act, so that we can file the return by the 31st of July. This is how the ITR will look when it says that whether you were a director in company at any time during the year. So even if you were a director in the company, even if one day during the previous year, you'll have to put a yes and give the details of the company. However, the changes have now begun. Explanations of the ITRs for assessment year 23-24 is what I'm going to look at right now. There is a 7 proviso to 139(1) which says that what kind of assessees have to necessarily file the return even if they have crossed no slab rate. So there initially till assessment year 23-24, those assessees were deposited an amount or aggregate of amounts of 1 crore or more in the current account, whether in one current account or many current account, could have filed ITR 1. Let's say I'm an individual having a current account just for the sake of it and holding it, ITR 1 was available. But since we are aware that current account means I'm having some kind of a business, that is why they have abolished ITR 1 applicability to that kind of a scenario. And now only ITR 2, 3, and 4 are available for those assessees who have deposited an amount or aggregate of 1 CR in their current accounts.
Divya, I just got a request from few participants. We can go a bit slower, then it will be better.
All right, I'll tempo it down.
Yeah.
Sure. Yeah. But I hope until this slide, this is okay, or do you want me to take up any other slide or just re-explain anything?
No, I think it is fine, but from now on, you can go a little bit slower. Yeah.
Thank you. Fair. Now we are looking at the taxation of virtual digital assets. Virtual digital assets total taxation had already come up till assessment year 22-23 ITR. But now they have introduced Schedule VDA, which says virtual digital assets. The flat tax rate is 30% under section 115 BBH. This schedule is not available in ITR 1 and 4. So if you're a salary class of income, you will necessarily have to file ITR 2. If you are business income, but you're going for presumptive taxation and that you have invested in VDAs, you will have to go to ITR 3. So you will have to be very careful while organizing your computations and organizing the selection of your ITR before you start filing the JSON directly. It is better to have one kind of a space available in your workings that you know which ITR shall apply to you. In VDA, there are two parts. You can have it as business income or you can have it as capital gains. How do you know you are taxing at business income or capital gains? As long as we go to circular of the year 2016, it says as long as the assessee has selected it, any asset to be part of inventory or part of your investment, the assessing officer will not question it, but I need to follow some kind of a continuity. So let's say I put it in the investment and I would to show it as capital gains. There is no indexation available. There is no other flat rate of 10-20%. It is at 30. So in column number 2, which is this, is date of acquisition. So I will say, let's suppose I have put it as 1st April 22. Date of transfer would be say 28 February 23. I would have to select what kind of head do I want to tax it in. Now, in case it is a gift, I can take the cost of the previous owner. Unless and until not, I will have to show the actual cost that I've invested about, whether it is as a business asset or a capital asset. I write the consideration received. Here, the word consideration doesn't mean to be consideration defined under section 50C. Consideration is a layman term. It says what is the sale price. The difference will automatically be calculated in column 7, but please note losses cannot be carried forward or utilized. It will automatically pick up 0. Therefore, if you see part A and B, the total breakup of income from PGBP and CG will come separately. The question would arise, what if I want to consider Ethereum as one of the VDAs as business income and income from Bitcoin as capital gains? Can I do that? Presently, there is no clarification on that. I would say I can decide for myself what I need to do and how I want to do, because regardless of the fact there is a flat rate of 30%, there is no setup available. So I can do whatever I want to in this schedule. These are just certain highlights of the changes that have been come in the ITR, and you can take a look at it. The presentation will be shared by Utsav in your organization once I've shared it with him by this evening. Let us go to the new insertions also of the ITR. There is a tax of BBI. So this is the same as the VDA tax of 30%, which is applicable. Of course, surcharge and education cess will be added on that. Like Schedule TDS, Schedule TCS was already available, and in that Schedule TCS, a new header has come which says available in your hands or others. Likewise, there is a rule which says that you will have to apply to the collector of the TCS and tell him that, look, this is not my TCS. I don't want to claim it. I want to pass on to the other person. Please give me a certificate. You have to make sure that while you're applying, the deductor or the collector of the TDS or TCS respectively has made sure that your declaration and acceptance thereof by them has been put it on their file and on their records. It needs to be taken care of by the deductor and collector. He cannot just lose that document, because if in the future assessing officer has sent you a kind of a question or a query via any mode, you will have to present that as well. We are coming to a very, very difficult part of the session, and this is about ITR 7. So I will go much slower than possibly I can. and we still need to cover up at least 40 slides up till the end of the session. I will try my best to explain ITR 7. ITR 7 is broken up into two parts, part A, which is general information, and part B, which is the outline of the total income and tax computation. What has changed is one part in general information, where initially used to give the details of the number of the provisional registration, whether approved or not, but now that is no longer required. You can only give, and you should only give the information if your registration has been granted, and you have to necessarily and mandatorily give the details of the approval under the Income Tax Act, whether it is under Section 12AB or under Section 80G subsection 5. Both sections, if approved, whether or not, have to be given. Now, what do I mean by whether or not? So let's say I have applied for 12AB, it is approved, I need to show. But if I have not been approved of 80G subsection 5 as yet, it's okay if I don't show it. If both are approved, I need to show it. Go to the second part, where it talks about the total income and the computation thereof. Initially, the tax computation was very simple. You have gross receipts, you have exemption under section 11, which is direct expenses, whether accrued or whether you're paid. Then there was 11.2 provision, which says you can accumulate for 5 years, park it in investment, and claim the exemption. There was another one where it said that corpus is a voluntary donation. So 11.1D said that as long as it is parked in the corpus, it is being used for the purpose of the corpus, there is total exemption. Loans and borrowings, even if loans and borrowings were initially allowed as application, despite the fact the loans and borrowings were not repaid to the lender, they were allowed as expenses. Everything has now turned about, except for the fact that while you're claiming expenses in ITR 7, except for the fact that as long as you are in the ITR 7, you can claim the exemption. You can claim the exemption as long as you have been spending the money. Now, let's suppose the trust is applying for on the mercantile system of accounting or cash system of accounting. So when I'm in cash system of accounting, I may have to provide for audit fees because the trustees want an expense, and I have to put in notes to account that except for the audit expenses, everything else is running on cash system. Those audit fees now not be allowed under the application of income. While I'm on mercantile, I would have to provide for March, electricity, telephone bill, etc. Those expenses for salaries. Now they won't be allowed as long as they're not paid. So it is better that the charity trust are actually spending that money in real. Two, if you've taken loans and borrowings, it is better that to claim expenses while the loan and borrowing has been repaid to the lender. Only then can you claim that kind of an expenses, which we will be seeing in the rest of the schedules. The third part is if you have earned a corpus during the year, you need to give a corpus certificate to your charity commissioner. But while we're speaking of income tax, you will have to claim the corpus as long as it is parked under investments. What are those investments? Investments as specified under section 11.5 are those investments under which that corpus money received during the year will have to be parked, making sure that any corpus received until 31st March 22 for the financial year 21-22 has not been come out of the investment which are sitting right now as at 1st April 22. What I mean is that the investment which are lying for the corpus received for 1st April 21 to 31st March 22 should be spent within 5 years. It is the exact logic of 11.2. But if the monies are coming out for any other reason than the reason for which the corpus donation was paid to you, then it can be called as deemed income. Your Schedule I, Schedule J, Schedule D, all these information are going to grab your hands, grab your neck, grab the neck of the trustees and call for a lot of information, which are also forming part of your Form 10B, which is super massive. From 3-page audit report, it has now become a roughly 10 to 13-page audit report. What has happened in 10B is that for a larger trust, Everything what is in the ITR has come inside that, and what has come in the 10B has come into ITR 7. So they acquire mirror of each other like a remittance certificate. The next point is that whether liable to tax at maximum marginal rate under section 64, if by any chance any property of the trust is being utilized by any other person not allowed to, the flat rate of 30% was being applied to charity trust despite the fact they are charitable in nature, despite the fact they are 12AB. This section or this point has been rescinded, although the section has not been deleted, but it has been replaced by a new question which says whether the provisions of 22nd proviso to 23C and 1310 are applicable. Let us see that in detail. 1013 says if you're violated section 12A and subsection 8 of the first proviso of 215. 215 mentions that your charity trust cannot be doing any activity in the nature of trade, commerce. It should be only doing work for reasons which are general purpose utility for the attainment of higher cause. If you come out of that logic and you start doing things which are not in the nature of charity, then you're violating 215 and hence 1013 applies. And because 1013 applies, there are certain restrictions of the expenses that you can claim from your application of funds. Likewise, similar logic has been built in 1023C, where the proviso 22nd has been amended for the same kind of a logic. Also, if you're doing any other activity for which you had registered and that you're going out of that logic. So let's say I had developed a trust, I had incorporated trust for school, but now I start doing dispensary work, I start doing cataract operation for the villagers, for the poor people. I have come out of the reason for which the trust was incorporated. So 12A and 12AB are also those kind of sections which can trigger some kind of a non-benefit in ITR 7. They also include violation for non-maintenance of books of accounts. Books of accounts are now prescribed by Rule 17AA. It is a massive section. All of you must read Rule 17A. What has happened? Whatever is in the charity law has been embedded in the Rule 17AA. It is like the ICDS of charity trust. While you're doing 10BB, these questions will be asked to you. While you're doing 10B, these questions will be asked to you. I am of the opinion that 10BB is a smaller form compared to 10B. If you have made any payments to parties which are 13(3) parties, 13(3) parties are authors, founders, managing trustees, secretaries, those employees who have direct nexus with the trust funds, they are related parties, like how we have related parties and partnership firm which are partners. So likewise, if you're doing any benefit from the trust to these kind of parties, then you are violating. And because of that violation, this kind of a condition will apply and you'll have to put a yes on that box. However, when you put a yes, there is no other column below it, which kind of leads you to any other thing. But on totality, A26 row will, if it says yes, it will take you to total income to be computed differently. Next change which has come in ITR 7 is that details of authors, founders, settlers, and trustees, excuse me, is being called for at any time during the previous year. Until last year's, it's said that these details had to be given only on the date of application. Now, what meant by date of application was date of application on which the income tax application was made. Now, at any time, if you had any single person acting as one of these, then you will have to give their details, which is name, PAN, Aadhaar if applicable, etc. New animal in ITR 7 is consolidated balance sheet. Last year, there was no scheduled BS. Now there is a scheduled BS in the balance sheet, which is only asking for source of funds, starting from corpus to investments. In the investment, there is a breakup, which initially said 11.5 had to be bifurcated into investments under 11.5 or not under 11.5. So investment had two columns before. whether you have invested under section 11.5 or you haven't. Now, you will have to only show a grand total of investment held by you during financial year 22-23. This is a general provision that I put for how to compute if you have violated, and when you put a yes on that little box of 826 line item, this section will apply to you. So it is very important that you read 1023C, proviso 22nd, 23, section 1310, 13.8, and section 215. I would repeat for the paucity of those who are making notes possibly. 215, 2 bracket 15, 13 bracket 10, 13 bracket 8, section 1023C, 22nd proviso, and 23rd proviso. Once you put a tick, this box will appear in front of you where you will automatically know what are the expenses which are disallowed. This is exactly copy pasted from the Act. So it is okay to know the Act via the ITR. And these are the additions which will be added from your schedule BBI. BBI schedule is basically coming actually from those charity trusts who are onto exit route, the exit tax which is being notified, and also my bad, not the exit tax, but the section applies to those trusts who have violated even application of income under 11.2. So let's suppose I had invested 1 lakh rupees into 11.5 mode and claimed it as an exemption under one of the years under 11.2. Now that income will become taxable if I have removed it from my investment before 5 years or misutilized when I had said in form 10 that this is where I will utilize it, but I didn't utilize in that way, then 115 DBI tax rate of 30% shall apply. So addition is the part of the taxation and the total income under which the total income of the trust will be computed. ITR 7 honestly has become complex since the JSON is not out. Whatever I can figure from ITR 7 is what I've incorporated at the moment. I am not able to give you practical live examples because even the softwares that I use or any other could not give me a productive outcome. Schedule A in ITR 7. If you remember till last year, you had Schedule ER and Schedule EC. I'll go one step further. Okay, so Schedule ER and EC were those schedules where Schedule ER said that I need to give a breakup of the debit side of my profit and loss account, although it did not correlate with any part of the ITR. It was just like a disclosure, but I, as a CA or a taxpayer, would be sure that this is the expenditure during the year under the revenue items. Schedule EC was one of those schedules which says expenditure of capital account. Both these schedules have become redundant for assessment year 23, 24, and Schedule A has been encrypted with a breakup in a columnar format. That is the only difference that has come out. The question arises, do I need to give all this information? Possibly yes, because you are giving disclosure of the ITR and the disclosure of application of income. What if I take a decision that, look, I do not want to give a breakup of everything. So can I put all the details under any random head by calling it a general public utility? The answer could be possibly yes. Schedule D was already there, which explains the deemed application of income. 11.1 explanation 1 clause 2. This section explains that I can accumulate the income for 1 year or maximum 2 years because I have not received enough funds. And the income of the charity trust is on mercantile basis. And although the income has accrued and arisen to me, I need to offer it for taxation. But since it is not received, I can call it as application by saying that I'm filing Form 9A with the income tax 2 months prior to the due date, and here is what I'm doing. What happens if you're not applicable to 10B or 10BB and you need to fill Schedule D? You will have to file Form 9A or Form 10 before you file the return of income. Usually, you will not be applicable to this kind of scenario because only if you cross the threshold of 2,50,000, that is the slab rate applicable to individual being applicable to gross receipts of charity trust, you will have to go for trust audit, which is equivalent to tax audit under 10B or 10BB, which is under section 12B and rule 17B of the act. So this whole section, rule 17B rule and section 12B, all these things tell you that if you cross a threshold of more than 2,50,000 during financial year 22-23, you will have to go for tax audit under the IT Act. Then only possibly you will have Form 10 and Form 9A. But very slight possibility that without that, you may have to fill Schedule D and file Form 9A for the 1 year provision, 1 year application of income, 1 year accumulation of income. The word is actually not accumulation, but for the sake of clarity, I'm using this word. 2 new columns have been added in Schedule D, which says out of the deemed application claim amount required to be applied. So now if you had in past financial year 22-23 applied that income, then you had withheld that tax, withheld that application and expenses and kept it for this year. So it is just asking you for a breakup that out of the deemed application amount, how much are you requiring to be applied in that year. So it is asking you for a breakup of 22-23 onward. It does not say that it will now be taxable if you not received your funds or whatsoever, but it is also actually asking you whether it was taxed in the earlier years and whether the income has been received or no. The Schedule D will lead you to Schedule DA, where there is a total breakup. Now, because of this breakup, the assessing officer will know that in which year you had accumulated for a year or more, in which year did you get the income, in which year did the application happen, and in which year would it be taxed if that money is not received. Likewise, similar logic has been come to Schedule I. This is for 11.2 or similarly 1023C and rest of the sections. Presently 1021, red with 35.1 has been inserted. The section on the top line out here for scientific associations. Until last year, everything was same except these 2 columns because now they want to know the breakup of these investments that you made by withholding the accumulation. So if I've underspent more than 85%, I have an option to accumulate under 11.2, park it under investments for 5 years and give the details here under. Give the purpose of accumulation. The purpose of accumulation under column 3 will be actually what you mention in your board resolution while filing Form 10. This is giving you a year-wise breakup of section 11. It unfortunately is going into 15 columns. And here is the yearly breakup, like Schedule DA. 115 BBI is special and specified income in certain institution for the violation that you created. So you'll have to show this separately, which will go and sit in the A26 computation that we just saw some time back. Schedule J explains us how and when and what corpus was there with me up till 1st April 2020 and onward. For financial year 22-23, retrospective amendment has been made for assessment year 21-22, wherein it says that if I am giving a donation for the repairs, maintenance, renovation of a trust which has a temple, mosque, gurudwara, etc. of that nature, then I will have to park it necessary in the corpus. It does not disclose the fact that the donor will have to give you a letter of corpus. It is better you take a letter of corpus and park those funds in the corpus and give these details. Including last year, as I mentioned, the investment had to be shown in the corpus and all those investments have to be held up till the 5th year. Similarly, details of loans and borrowings in part A2, which have a breakup, and then they run into whether investments and what are the modes of investment for the above corpus. Basically, in ITR 7, all the law that has changed has been incorporated, and one will have to be very careful much before you sign off your charity trust audit and your 10B or 10BB, that how are you going to project all these details in ITR 7. Possibly you'll have to make a robust checklist at your office and make sure that at least 1 or 2 people in your team, even if there is a problem with the staffing solutions, will have to be really robust with the trust sections. This is the new addition in the column where it says 21st proviso of 1023C. Similarly, in 13.3, we had spoken that if any special kind of benefit have arisen to related parties, the same logic has now gone into 21st proviso of 1023C. While I was talking about the violation, you'll have to give the name and address of the concern to whom you have actually made any kind of an investment during the year and given those benefits. So it says investment held at any time during the year in which persons have a substantial interest, which means that if I'm a trustee and I am a director or possibly even if a shareholder in Aditya Birla, and Aditya Birla Mutual Fund is my related party, I have a substantial interest therein. Substantial interest will have to be defined under the Income Tax Act. Then I will, as a trust, have to disclose Aditya Birla here and give the details thereof. This is for political party. One more line item has been added for Schedule LA, whether recognized by the Election Commission of India. If yes, what is the date of recognition? Nowhere else there has been a change in the Schedule LA. The next is Schedule R. Schedule R is a little reconciliation that you would do of the corpus, which is the Schedule J, giving breakup of the corpus with the balance sheet. The corpus breakup will have to start with the closing of 31st March 23 and automatically seems like it will pick up from Schedule J, and then the reasons thereunder will have to be maybe mentioned by hand or automatically come out. Presently, I have no comments on it. We are done with ITR 7, so a sigh of relief, and you can calm down a little because the other law is more fun and the other part of the ITR is more fun as well. In the verification of the ITR page, wordplace has been added for ITR 5 and ITR 6. Initially, this word was not there. What is a crucial change for e-verification of the ITR? First, let us understand the last part. I can e-verify ITR in 3 ways. One is manually signing ITR-V and sending it by speed post. 2, digitally signing on the spot. And 3 is I can do through Aadhaar OTP. Rule 12 of the Income Tax Rules 1962 explain me which kind of a assessee has to follow mandatory DSC. Those people are those individuals or HUF who are applicable to tax audit under 44 AB of the Act. The company, which is a private or a public limited company, and any other assessee, you can do EVC, transmission through digital signature certificate, which is a DSC, example, Kotak, Punjab National, etc.
Divya,
But the OTP will only be applicable and valid. I'm sorry?
There was some connection issue at your end. Your voice.
What was the last thing you heard?
The e-verification thing. I think.
Okay, should I start with the place part or the entire thing?
Entire.
Okay. So verification schedule, which is part of the ITR, has a word place embedded for ITR 5 and ITR 6. Until last year, the word place was missing. So now you'll have to mention from which place are you filing the ITR 5 and ITR 6. ITR verification is the part where you upload the ITR, and there are three ways in which you can e-verify your ITR. One is EVC, which is electronic verification code, digital signature certificate, and manual signature. I will first talk about those who have Aadhaar to kind of revamp what I was saying. Aadhaar OTP is applicable to and can be applied to those directly who have Aadhaar applicable and their Aadhaar number is mentioned in the ITR and has been linked to the PAN and CPC. So it's very quick. The mobile numbers have to be same. Hence, you can do the same. If not, there is a problem. What would I do with the non-resident individuals? I would possibly make a digital signature certificate for the quickness, because giving EVC will become very difficult for them. What is EVC? Electronic verification code can be generated if a mobile number is same in CPC and that same mobile number is registered with that bank which has been listed by the income tax department. EVC is applicable for 72 hours. It is valid for 72 hours. It lapses thereafter. There becomes too much of a communication while you are in a heavy season of filing ITRs in July. The new and the scary part, but a good part, I would say, so everything finishes quickly and you don't have to wait for the 120 days, which was the earlier case. CBDT has now reduced the ITRB manual signature to 30 days from the date of filing. Now, what happens if you send your ITRB after 30 days? Your ITR becomes invalid, even if you are sending it before the due date of return. Let me give you an example. I filed my return yesterday, 30th June. I send my ITRB on 28th of July. That is okay. It is not invalid. But if I send my ITRB after 30 days, it will become invalid. Therefore, we will also go to the question and answer that has been put here. It says, what is the time limit for sending a signed copy of ITR? Initially, it was 120 days. Now it is 30 days from the date of filing. When it is 30 days from the date of filing, and the 30 days have lapsed also, the assessee can request for a condonation of delay by providing appropriate explanation so that invalidation does not take place. However, the point also is that there was a clarification in one of the points where it said that if you have verified the ITR after 30 days, the e-verification will become the date of filing, and date of filing will be considered as speed post date. I construe it this way, that if I file the return on 30th June and if I send my ITRB on 15 July, my return filing date will be considered as 15 July. But if I send it after the 29th of July, which is 30 days after I filed my return, it will become invalid. Practically, this seems a little difficult, but it is better either you create a digital signature or do through Aadhaar OTP or immediately send the ITRB by asking your clients to immediately post it out from their houses or offices. Here are the important schedules of the ITR. Schedule foreign assets, foreign source income, TR, that is tax relief, assets and liabilities, AL1 for unlisted companies, TDS, SPI, IF, OI. IF means income from firms, SPI means special person income in case of clubbing or your child who is a minor, and OI means other income, other information which is applicable in case of tax audit. This schedule is actually a small replica of your 44AB 3CD. Form 3CD and OI will match. OI will pick up the data and disallow or allow expenses in your schedule PGBP. Pass-through income, from which your pass-through income will give you a breakup of what is under other sources, capital gains, etc. We will see, and some other information we will see. Let us see Schedule FA. Schedule FA is for disclosure of foreign assets. It will have to be only be shown disclosed by resident or an ordinary resident, not applicable to RNOR, not applicable to NR. When is it applicable? Let's say I have an asset as at 1st January 2022. Do I need to disclose it for financial year 22-23? Assessment 23-24 return? Answer is yes. So mentally you will have to say that calendar year which fits into the financial year is what you need to disclose. Whether I need to disclose an asset which is on 1st January 2023, I'd say no. The FAQ published by Taxman is very clear about these questions. There are 73 questions by Taxman's FAQ on the ITR assessment 23-24, which also includes very basic knowledge as well. In case you need more information, you can go there and read those questions. We go one step further. Let us say I have Facebook Inc. shares which are listed in New York Stock Exchange. Do I need to show that under unlisted shares category in the ITR? The answer would be no, because the question doesn't say whether you are holding unlisted shares at any time during the year in India or outside India. It just says whether you're holding any unlisted shares. So you can refrain from filling that part of the ITR. What happens if I cross more than rupees 50 lakh gross total income? Do I need to fill Schedule AL? Answer is yes. So your foreign assets will also form part of your Schedule A under the block of investment under share or securities category. So Schedule FA, unlisted shares, and Schedule A will have to be shown. What if I hold unlisted shares outside India? Answer is I'll have to fill Schedule FA and unlisted shares. What if I hold unlisted shares outside India? When I have gross total income of 50 lakh, I will have to fill Schedule FA, unlisted shares, and Schedule EL. What if these shares are forming part of scheduled balance sheet? Unlisted shares, if forming part of balance sheet, then you need not fill Schedule AL. Schedule A is very specific. Schedule AL says assets and liabilities held during the year if not forming part of Part A of DS of the ITR. Hence, you need to see the headers of the ITR form before you get onto JSON, before you get into any Winman, Taxbase, or any kind of software for clear tax that we use throughout the country. Now, what if you're a signatory outside India? Whether ITR is applicable? The answer is yes. If you're only signatory outside India, whether you're a beneficial owner or whether you're a custodial account holder, you will have to file ITR even if you are not having any income under 139(1), which crosses maximum amount not chargeable to tax. So you will have to read section 139(1) explanation 4, and that will also explain you what is a beneficial owner. Beneficial owner means an individual who has direct or indirect consideration for purchasing that asset or has held that asset for an immediate or future benefit. So there are 3 conditions which you need to remember, which are not cumulative, could be separate as well. Having a foreign asset or a foreign bank account or a share. 2, you're a signatory outside India, maybe as a foreign trustee or foreign private trust trustee, etc., or a foreign director. 2, whether you are foreign director in a bank account. Beneficial owner, you can see the definition and decide whether you fall into the category or not. There is a trick of filing Schedule FSI, which explains broad categories of all these 4 items and how the income therefrom is broken up into what is forming part of the total BTI. Now, what is BTI? It is total taxable income, which is part BTI, total income. You will have to mention tax paid outside India, which has to be computed as per Rule 115. We will see a live example in an Excel that I'll show you now. Tax payable on such income under the normal provisions of income tax. How? We will see again. Tax relief, which is lower of the 2. So if you have paid tax of 40% or 30% in India and you've paid withholding tax of that foreign income at 25%, you can only claim 25% on the foreign income here, as long as you have a tax residency certificate, as long as obviously there is a DTAA or a CTA. The word CTA still not come in the ITR for now 2 to 3 years. I suppose they want to call it double tax avoidance agreement. And we have to ensure that we understand that that country has signed the MLI with the other nation, and hence it's called the CTA. CTA means Comprehensive Tax Agreement. Any country with which India has signed a MLI, you will see 2 treaties under the income tax website, one is the DTAA, and one is the synthesized treaty. Synthesized treaty is actually the CTA. Allow me to kind of open the Excel. So if you select the country, the country code will appear automatically. The date of receipt will have to be put, which can be as per the FIRC, that is Foreign Inward Remittance Certificate. The tax identification number will come from the challan of the foreign country. Let me call it a challan for simple sakes. You will say what is the exact income and under which source of head does it fall under. Let us assume for 2 times the client is earned 1565 euros. Now, what is the euro and the rate? Now, this rate is actually on the 30th of April, the euro rate, and this is on the 30th of September. I will repeat, 30th of April euro rate and 30th of September is a euro rate that has been multiplied. This is just plainly as per rule 115, a very lucid and easy rule. Similarly, because of the tax challan, I know that the client had actually been deducted upon of so many euros. Hence, I've taken the same because even the rule says the same thing. Let me clarify, 115 is very specific for taking the last day of the earlier month in which the income had been received for dividend income and income from other sources, etc. But I think for specific income, it is a different rule. Most of the sources of income is the 30 of the earlier month. Now, my total tax in India as per my computation, as per normal provision, is 4054, and total income in India is this. So let us find out the tax rate actually. On an average, I'm paying 31.97%. So let us say it is 32%. I can blow it up into decimals. On that, what is the tax that is applicable in case this income forming part of 126 is there? So 126 actually is inclusive of 2,75,000. And on 2,75,000, I'll apply the tax rate. So I'm getting the tax payable on such income under normal provision of income tax is 88,000. How do I know what is my tax relief? I'll take the minimum of tax paid outside India and this tax. Hence, there is a formula. I will have to see under which section does the treaty apply, whether it is 90 or 90A. 90 or 90 explains that you can take a tax relief as long as there is a treaty between the foreign country and India. 91 says that the treaty is not available, and possibly because of that, you will not be able to take the double tax treaty benefit. Hence, your income from outside India and schedule FSI other sources will show 2,75,000, tax paid outside India will show 97,000, tax payable will show 87,000, and relief will be lower of the two, and you will have to mention the relevant article of treaty. How do you know the relevant article of the treaty? Usually you open the treaty, you understand that for dividend is a so, business income it is article 7, capital gain it is article 13 or 14, house property you may have to maybe go to other income which is or residuary income clauses. Now if you have capital gains outside India, there is a column for your information which says article of the treaty, the name of country, and the total income and the rate as per the treaty, whether TRC is obtained. So all this is beneficial for you to be filled up, because without this being a yes, whether TRC is available or you will not get a tax benefit. Very importantly, while claiming the tax benefit, the treaty benefit, and also the tax credit of the foreign country, you will do two things. One, file form 67 before the due date of return, although the law says that you can also file form 67 before the end of the due date of belated or revised return, even if the return is being filed before, I would file Form 67 under Rule 128 before claiming treaty benefit in the ITR. Second, I will make sure the client has given me a declaration that whether in the future or in the past, the same amount has not been refunded to him. In case he feels that amount has been refunded to him, or he knows that it will be refunded, you will not claim the treaty benefit, because that will actually be double misavoidance, non-avoidance of taxes. Schedule AL. Schedule AL, as I said, with Schedule FA, but independently let us see Schedule AL. We will see that why Schedule AL is to be filled and how, in case I'm sorry, in case you do not have any kind of assets or liabilities that are encrypted in your Schedule AL, you will have to mention a 0, because without that JSON will not go forward. ITR will not generate a completely valid JSON. What if the assets are forming part of my balance sheet? No problem, do not fill Schedule AL and keep it 0. What if those assets are not forming part of my balance sheet? Yes, I will have to show Schedule AL and disclose my details. This is what we were doing. Schedule TR, that is tax relief. A country code, because I have already selected the country code at the top, it will automatically come here. The TIN number would follow the taxes paid, relief, and the section. If you see point 4, it says whether any tax paid outside India on which tax relief was allowed in India has been refunded or credited, and the details thereof. So the department wants to know outright in the ITR, what have you been doing throughout the financial year, whether you are an individual, HUF, trust, or a company or a firm. A small write-up had come in the Economic Times or Mint, I don't remember, that how foreign stocks are declared in the ITR. One can possibly look at this example where the last part is very crucial, where 25% is the withholding tax in the foreign country, 27.30% is in India, lower of the two has been applied to, and hence the tax credit has been taken as 2 lakh for the exact way in which I showed you the Excel. This just shows that how 3 scripts of America has been shown in Schedule FA, has been shown as a Schedule TR, etc. One important thing about this slide is if you see this part, which I am moving my cursor about, is that if you're a custodian account holder, you will have to show the disclosure of the dividend income plus the assets lying in your custodian account. Custodian account is parallel to the similar logic of having a demat account in India. Schedule SBI, I have a child who is a minor. I earn the maximum compared to my husband. I show the name of the person, optional PAN or Aadhaar if my child doesn't have any, my relationship, daughter, son, amount of total income, and head in which it is included. What happens to those children's 26 AS from which I am offering the income and the TDS needs to be claimed? I will claim the TDS in my ITR, and under Schedule TDS, I will say that it is from any other person. I will not have to file the ITR of the minor. In the case of AIS and TIS, and respond that it has already been forming part of anyone else's ITR. I'm quite clear that no intimation of any sort will come to you. Make sure that you have a robust reconciliation prepared in such cases if your children have a lot of investments. In case of clubbing, you will have to be quite careful and see what is the law in your favor or not. But here it is a very simple thing. It is just asking you for minor child income. But yes, in case of section 64 in clubbing, you will have to then find out what is the income arose through your assets in the case of your spouse or likewise, and reflected accordingly. Here the line also says minor child, etc. So section 64 will have to be seen once more before you start filing your ITR. In such cases where asset has been transferred a declaration would have to be taken from the client that during the year no such asset has been transferred irrevocably, where the income would arise to the tax filer, but it has been shuffled to the spouse or any other person. Schedule IF is very simple. When you are showing capital balance as 31st March, you only have to show the fixed capital asset. This is mentioned in the instruction of ITR 5. If not at the present instructions, years ago when Schedule IF was introduced, it was already mentioned, and you do not have to show the fluctuating current account of the partnership firm. For example, if I am a partner in ABC LLP, I will say ABC LLP, the PAN, whether applicable to audit, yes or no, which is tax audit 44AB. If yes, my due date will become 31st October. Whether section 92E applies, yes, then I will have to file my ITR on before 30th November. Share in the percentage of profit. Percentage share in the profit of the firm obviously means PSR, no other loan interest, any kind of remuneration, PSR or whatever, only the ratio in which your profits are being divided in that LLP or the firm. The amount of share in the profit. Unfortunately, those partnership firms who are on cash basis, their partners will have to pay tax on the remuneration, which may be received in the month of April for the month of March or so, for the purpose of clarity, because it is asking for all the information here under, where not only Schedule IEF, but PGBP will also ask you remuneration earned during the year. It does not explain accrued or arisen. One can take a decision under section 28 subclause 4 that and section 5 of the act that it is accrued and arisen. I follow cash system of accounting and hence so. But if you're following cash system of accounting, you will have to prove that what are your books of accounts. Whereas as a partner, you don't maintain your books of accounts. So it is better to keep clarity and keep easefulness. You show the remuneration paid by you in your current account by the firm, if not in your bank account, as your remuneration for the year. Schedule OS, one change. Whenever there is no exemption on the interest on PF, you will have to disclose the various items. What are the breakups? Section 10.11 and section 10.12, bracket 11, bracket 12. They speak about interests that are exempt on the contribution of provident fund. 10.11 talks about government employees provident fund, and 10.12 talks about non-government employee provident fund. If an employee has contributed to provident fund of more than 250,000 during the year and interest is accrued or arisen thereupon, then it will be taxable under income from other sources. It will no longer remain exempt under those section 10s. What if your employer has not contributed to help you out? Then in that case, the employee's contribution will be considered to the cap of 5 lakh rupees instead of 250,000. So up till 5 lakh rupees, you will not be chargeable to any kind of tax, even if the interest is accrued or arisen, if your employer is not contributing to your PF. One another point is no account case is applicable in those cases where books of accounts are not maintained and maintainable under 44 as per 44 AA and presumptive taxation. You will have to at least fill one of these. Simply, you can fill the right kind of cash balance. What if the assessee does not have a cash balance? You can put 5,000, 10,000, 25,000, but leaving this column blank and writing 0 will give you a defective return. Our main purpose is not to have a crazy intimation, also not to have a defective return. Pass-through income will come from your form 64C that the venture capital company, the venture capital fund has given to you. The breakup will have to be embedded here. Presently, column number 7 is actually redundant because the venture capital funds losses have to be claimed by them and not by the unit holder. Hence, it is quite redundant and you can just kind of ignore it. The TDS will come from an AS and 26AS, which is column number 9. After filling this, your breakup will come in gross total income, where your PTI will be shown here under B4. And if it is a capital gain, it will come under B in OS part 7. Of course, presently the amounts here and amounts here will not match because they are from different ITRs that are picked up for a purpose of explanation. Here is one more example of having it as long-term capital gain. Form 67. What are the due dates for Form 67 to claim foreign tax credit? As I said, origin return on before the end of assessment year. If you're filing a belated return and you have foreign tax credit, you will have to again file on before the end of assessment year. And if it's an updated return, you will have to file immediately before the date of filing of ITR. In case a taxpayer is willing to take benefit of special rate of taxation, then the companies will have to file Form 10 IC, that is 115 BAA. 115 BAA is for 22%, in which case MAT will not apply, and BAB, in which case you will directly go to 15%, again MAT will not apply. 115 BAC for those individuals who are going from old regime to the new regime for the first time, and they will have to file Form 10 IE only if they have PGBP. Those who do not have PGBP and want to go from new to old, they can do a hop, skip, and jump. Up till this year, from next year, they'll have to do a hop, skip, and jump from new to old and vice versa. 1 point for next year, what will happen next year? There will be a default regime of new regime. So under the new regime, I don't have to file Form 10I form to continue. But if I want to go to the old regime the first time or maybe another time, then I'll have to file Form 10IE. Thereafter, I can only come back once to the new regime and not go back if I am holding income from PGBP. So the problem is only in the case of PGBP that you can take a reswap only once. I'm saying reswap, not swap. Cooperative society, they can be taxed at 22% instead of 30 under the new regime 115 BAD, which is 10 IF form, which needs to be filed before the due date of returns. This is a slab rate that we're all aware of. Now, the tax relief, apart from 5 lakh, will become at 7 lakhs up till 12,500, compared with the income tax, whichever is lower will be your tax rate. So for example, if I have earned a total income of 4 lakh rupees and tax thereupon is, let's say, 10,000 rupees, my relief will be 10,000 minus 10,000, because my relief is only applicable below 5 lakh rupees and also up to the extent of 12,500. Some part of the ITR which one must be aware of. I am explaining this schedule so that when you're filing ITR for AOP BOI, let's say estate of a deceased person or a private trust, you must mention the name of the trustees or the members or the beneficiaries. Even if the percentage is not defined, you will have to do an equal percentage. The reason is that if you do not put a percentage, then the AOP BOI will be taxed at maximum marginal rate. I'm not asking you to evade taxes, but I'm making sure that you are aware that, for example, the gymkhanas and the clubs, which are AOP BOI, are working for the benefit of its members, and they cannot be charged at maximum marginal rate. Because of the loophole in the ITR and the law of AOP BOIs, you will have to show some kind of percentage to show that it is a determinate trust for section 167B of the Act. Aadhaar, if eligible for Aadhaar, you can skip it if you don't want to, but I'd purposely put it because I'm already putting the name of the trustee and the address. Of course, rate of interest and remuneration paid payable is mandatory in the case of ITR 5 for LLPs and the partners. The remuneration paid or payable is why I was saying that it is better you tax your remuneration even if you're not received in your bank account. Details of tax deducted as source. The financial year in which tax is deducted and tax brought forward. So let's suppose in this year, I have received an income as a doctor and I'm following cash system of accounting of last year. Then the financial year in which the tax was deducted will be 2021. So you have to remember the financial year is the April of that financial year, of which TDS you are bringing forward to claim in financial year 22-23. No account case once again. Static information for audit. Please make sure that this schedule is filled correctly to avoid any defective or late return intimations. Because if you are applicable to maintaining books of accounts by AA, then only you will go under 44 AB tax audits. And hence this becomes very crucial. Of course, the section whether 44 AB applies or not is because of the new law which has come already from last year, crossing the threshold of turnover or not, cash expenses, cash income, etc. While you're giving the details of an accountant, which is defined under 288 to be a chartered accountant under ICAI, you have to make sure you are giving the PAN of the firm. If you're a proprietor as individual practitioner, then you will have to give the similar details. But if I'm a partner in a firm, let's say BD Jokhakar, I will have to give the detail of the PAN of my firm. Date of the audit report, very crucial. I would put date of audit report as the date on which the 3CD is being generated, even if the client is accepted after 2 days. So if today is the date on 1st July that I have uploaded my 3CD, I will put 1st July here. Second, there is no mismatch that will happen. But thirdly, I am also making sure the client is accepted. And fourth, that I will become very quick with filing of the ITR. Of course, you will file the ITR only after the acceptance of the TAR, that is tax audit report, but at least my ITR is ready to go in the peak season. Similarly, you will do the same for 92E, which is transfer pricing audit report. International transactions, those are covered with associate enterprise, 92E, 92B, 92A, and you will have to see 92BA for specified domestic transactions. If you're applicable to any other audit, let's say Maharashtra Public Trust Act, Gujarat Public Trust Act, Indian Trust Act, you will have to fill Part E so that your due date, if tax audits are not applicable, TP is not applicable, becomes 31st October. How to give feedback on AIS? These are the options on AIS. Information is correct. Information is not fully correct. Information relates to PAN of the other person. In such cases of minors or any kind of a legal representative is filing a return for himself. Information is duplicate. Let's suppose I have a dividend as a non-resident. So 26S will show a line item of 195 dividend and 115A section dividend. So out of all the three, I would cut out 195, I would cut out 100A and keep dividend, or vice versa. Any option is okay, because the intimation will club all the three all the dividends. Information is denied, you can totally say this is not my income. I have no clue where is it come from, who does it belong to, none of my family members, none of my business. Customized feedback. This is based on the information category. If the transaction relates to an income, then an additional option, income is not taxable, shall appear in the feedback drop-down list, which is one of the features of the EIS, and you can give their information. Special points, let's discuss before we know that what kind of ITR applies, what should I do. You should always know what is the scope of your ITR. You should collate your information. Information can come from client data. So there is client data. You know what you're supposed to collate, not start collating, know what is supposed to be collated. Then you go and understand how your computation will be like a mental note. See previous year and know which ITR is applicable. Making sure at that time, pre-validation of bank has happened, that bank is still available, the bank is not closed, because clients normally close the bank account even if the year has been over. Making sure client knows that refund has been applied for. Even if refund bank is not ticked on, you tell the client, I want to tick all the banks, and wherever the refund comes, you should be happy about it, because CPC will cancel out whatever is not pre-validated. So your refund reapplication process actually ends. You don't have to spend much time. If you have a SWIFT account and you want to, as an NR, maybe a foreign company or foreigner want to earn income there, not as an ROR, I mean interest, income tax refund, then you can give details of a SWIFT account. Residential status. Residential status, you will have to verify from the residential status box, which is in the ITR, and you will can see if you are R, RNOR or NR. If you're LO, BO and PO, you will automatically become NR in ITR 6. Be very careful. Must respond to AIS, see clubbing of income and call out the duplicate entries. Quote your Aadhaar in the ITR. In case of NR not having a TIN, you can put the passport number that has been clarified in the clarification press release of FAQ as well. Defective in the IT in the same form. So what I mean is, let's say your ITR has become defective because of some reason, you can only file the same ITR to correct the defectiveness, but you cannot change the ITR form number. But if you're filing an ITR because you missed out on some information, you want to revise it before 31st December, you can change the ITR. So let's suppose I forgot I had PGBP and filed ITR 1. In revision, you can file ITR 3 or 4 if it is presumptive taxation. No account case for presumptive taxation versus Schedule AL. What do you do if you are under presumptive taxation and 44 AD, ADA, AE, and you have crossed 50 lakh rupees, you will have to fill Schedule AL, despite the fact that you have not maintained books of accounts. What do you do in that case? You get information of all the cost of your assets and actual cost of the liability. Cost will also include cost of insurance policies, life insurance, car insurance, motor cars, yacht. Everything has been explained in Schedule AL. Actually, the instruction of Schedule AL and AL1 for companies is massively described elaborately in the instructions. Schedule AL1 applies to private limited companies. Yes. Schedule AL1 is put in ITR 6. Schedule AL1 also applies even if you're putting the balance sheet of the ITR 6 companies. Hence, you will have to necessarily give the details, the purpose for which that asset was used by the company, etc., etc. Refund reissue, condonation for time by ITR, e-verification, everything is online. You do not have to go to the assessing officers. There is an application under your account and you can select that option and go for a new request. It is quite liberal and very easy to kind of see the flow. Must register digital signature before you start filing audit reports on the client portal or your ITR is being filed. It is a request that ITR 1 to 7, they seem like 20, 30, 40, 50 pager. ITR 7 is 23 clauses now. So you must read your ITR forms on PDF more than the ITR book that is released the ITR forms, so that you're aware of the schedules. You know what the schedule says, what are the headers, what are the contents. Brought forward and carry forward losses, Schedule BAFLA and Schedule SILA. You will have to be careful while filling those. Setting off losses, bringing them forward is the main game as well. This is mainly to just make sure that you do not have errors while you are generating a JSON. It is like saying, I'm not well equipped before I go to a cold country because I forgot my wind cheater. Automate your processes, create templates for bank summaries, financial notes to accounts while you're preparing FS, even if you're not applicable to tax audit, so that you're aware of the policies in accounting. Schedules of the ITR in Excel can be shared with the client for them to fill it and send it back to you, which you can upload or see and fill your JSONs. Check previous year ITR, double check your losses. Of course, for PGBP, you will have to see which kind of ITR, financials apply, not apply, presumptive, maintains the books of accounts, no account case, 44AA, 44AB. So there is an interplay of these sections while PGBP is applicable. 44A applies if you cross professional income of 25 lakhs or more, business income of 1 CR or more. So you will have to find out what is 60 lakh or more. So you will have to be quite careful. Another important point in section 112A, long-term capital gains of listed equity shares, where grandfathering is not applicable, ISIN is definitely not mandatory. There was a press release on the 26th of September 2020, which says that, and also the ITR 3 assessment 2122 press release that said that in case the grandfathering doesn't apply, you can accumulate the entries and pass one single line entry. So let's say I have 4 scripts: TCS, Tata Motors, L&T, and Infosys. I have sold them all for 50 lakh, different purchase date for 10 lakhs, profit 40 lakh. I can pass one single line entry in schedule, long-term capital gains under section 112A, despite the fact schedule 12A shows the word name of the script, name of the shares. I'm sorry, it doesn't say the word name of the script, it says name of the share. But because there is a clarification and instruction and the rule and the press release, there seems to be no problem. What happens in case your team says that, we want to do a repo, we are very scared and doing a risk because we have to replan ASI, AIS, and TIS for these kind of scripts? You can have a backup of your Excels, which are actually maybe log files, so that figures don't change. Prepare 4-line entries, short term at 15, short term at slab rate, long term at 10, long term at 20 for these kind of scripts, even if mutual fund, debt oriented, equity oriented, etc. And keep that backup and keep a footnote or prepare a note and keep it for the client along with the computation and ITR for them to be easeful, because your broker is already sending you that information. The case of decease, let's say my friend has died, I need to go to his portal because he has picked me as a legal representative. Or let's say I die and my son has to go to his portal and register himself as the legal heir. Of course, as a legal heir, he'll have to show proof that he is the only legal heir for myself. He will have to he will have to put up PAN, my PAN, his PAN, again, the death certificate, legal heir proof, obviously, and the order passed like a probate. In this case, it is just asking for a probate. 90.99% you will have to get a probate to be registered legal rep. As soon as it is accepted, my profile will close and my legal rep will be able to file under my executor. Now the question arises, who has to apply, file the ITR, why the ITR? You're crossing slab rates, non-HUF and non-individual, mandatory like companies, trust, partnership firms, etc. You want to claim the IT refund and carry forward any loss. Of course, I am seeing this again. UID and house property can be also filed in a belated return. Any other loss will have to file the original return. 7 proviso of 139(1), very important and listed here, quite self-explanatory. Revised return and belated return can be filed before end of the assessment year, that is 31st of December. Updated return can be filed by any person to whom the specific conditions apply under section 139(8)(a). You cannot reduce your income, you cannot inflate your losses. It is mainly for those assessees who missed out something in their ITR. You cannot claim more refund. In case you missed out on carry forward losses, etc., should be allowed. And it can be filed with additional tax of additional income of 25% for the first assessment year and 50% or more in case of second assessment year, because it is till 12 months and 24 months. So till 12 months, if you file your updated return, 25% tax additional, subject to your already paid SA tax, or else 50% of additional tax. Try to avoid ITRU because it could get into more complications. Question 10 and 12 of the Taxman FAQ can be taken care of and seen. This is a song from Green Day, one of the bands that I like. And I'm happy to have any questions. In case if any, I can answer right away.
Thank you very much, Divya. That was very nice, technical and intriguing session. So now, if anyone has any questions, we can take those questions. We have time to take up questions. And meanwhile, Jai, there were 2 questions in the chat box. Can you just take those 2 questions? Meanwhile, we wait for other participants to raise their hands.
Okay, I'll just take it.
Okay, PPT will be sent to everyone. The presentation will be sent to everyone we have. Mayur bhai, even if you have any questions or anything, we can discuss.
Okay, I'll just take this question first. That is related to when assessee makes investment in the foreign land by sending money as a part of the scheme of such a foreign country for the purpose of residency of such a foreign country, will such an investment be part of the Schedule FA?
I'm not able to understand the question. Can you let me know if it is on the chat, please?
Yeah,
We will send to his personal chat.
I'll just share it to you.
Yeah, if you can just paste it, it'll be easier for me.
Okay, so Divya, that was from me actually.
Okay.
Just take this opportunity that I have rights to speak. So
Of course.
the question is like, normally, you know, we have clients who are investing in foreign land, in foreign governments, basically in their schemes, wherein they are able to get the residency by investments.
Yes.
Like Canada or Australia or you know, have US like EB5. So will that be also part of Schedule FA, wherein we'll say that, you know, they have some investments in a foreign land? Will that Schedule FA will cover such kind of investments?
Yes, I'd like to share my screen to answer this question so it becomes easier for you as well. So this is ITR where we see Schedule FA. And if you go to the last two parts, since the land is not in your name, we could skip that. This is details of immovable property held, including beneficial interest in any. And the second one is details of other capital asset, including any beneficial interest in any. I would say that if there is a financial interest of any kind, Schedule FA should be filled because you have already debited your bank account in India, and FEMA would obviously have been complied upon under ODI, and hence it is better to kind of show disclosure. There is no harm.
Question I had was with regards to ESOPs, right? Now, many of the funds and companies, they have their ESOPs which are outside India. They are vested or they are granted to the employees who are in India. Usually people forget to disclose those.
Yes.
Do you think those ESOPs should be disclosed? And secondly, if they are supposed to be disclosed, then when they are supposed to be disclosed, on grant or on vesting?
Okay, so on first question, the answer is yes, ESOPs have to be disclosed. ESOPs have to be disclosed because you're still having a financial interest on the day of grant. But while you're vesting it, it becomes your capital asset. Hence, you will show it from the financial interest category to your other category, which is a capital asset.
Thanks, Divya.
Sure. Should we take anything from the chat box? I think there are a few questions if you want me to address them.
Yeah, that is related to the Sivang sir's question.
Okay. There is a question. Okay, residence foreign country.
One question. NRI is out of India. CA is filing ITR from India. At the time of filing ITR in verification section, which place and date should be mentioned?
Ideally, the foreign countries should be mentioned, but unfortunately, your ITRV will be generated with your machine's code, which is your IP address. So there are two ways of doing this. If the client is available, you can create the JSON and file from his machine through AnyDesk or RustDesk, which is the remote machine. Unless and until you obtain a power of attorney from him and say that, look here, or maybe a letter of representation that even if I'm calling this Bombay, I am traveling or I'm not available, hence my CA is filing. I think that should be okay because you at least have some kind of a backup. So I would take a letter of representation from the client and file it from Bombay.
Any questions, everyone? Why you have any question?
No, it's away. Okay, I had a question which I got on my personal email from one of the members. I just I'm trying to find it out. Okay, so the crux of the question was that sometimes what happens is that the income as per 26 AS and the TDS on it is more. But when, especially in case of NRIs, it is seen because many times when their bank accounts are credited, they do a TDS on all the credits based on the incomes which are being presented to them. But the actual income sometimes is less. So when 143(1) is processed, they're processed with the pro rata tax credits. Like let's say if I have 5 lakhs of 26 AS showing 5 lakhs income with 50,000 worth of TDS, but my actual income and my actual ITR is at 4 lakhs. So they give the credit of 40,000 instead of the whole 50,000. That's a pro rata thing which is happening. So do we have any mechanism or online wherein we are able to correct this anomaly?
So are you saying that the income has been filed wrongly by the deductor, or that you have not received it?
No, the income has been filed correctly, but
Okay.
the TDS has been done more by the deductor.
Oh, so then what you can do is you can proportionally claim the TDS which is actually applicable to you. Because if the money has come to you, say 100 minus 10, 90, and not 100 minus 20, but he's showing 20, you can just file a grievance if you want to, or just inform your deductor to revise the TDS return.
Okay, so there is nothing in the tax return while filing.
No.
We can do some schedule which shows the something.
And if you have received less, then you claim the entire TDS because he's deducted more.
Exactly.
Yeah, it's like more commercial and mathematics.
Yeah.
Yes.
I am having one question. When
Ji.
we are claiming the TDS which deducted in case of a minor, in his mother or father whose income is more,
Yes.
at that time, since last 2 assessment year in one case, they are not giving the credit of the same. So is there any provision or something in return? We have claimed as other PAN in the return, where
Yes.
TDS we can claim. So is
Correct.
this a proper way, or there is?
Yeah, that is the proper way of doing it. Because I am also filing returns for the parents whose kids are having, I'd like to show you scheduled TDS. But it should not be a problem as such, because TDS schedule says TDS credit relating to self or other, and PAN of the other person. So that's what I was saying, that you will have to go to AIS and give a reply. Possibly you are not giving a reply under AIS, and hence the credit is not coming back.
Okay, thank you.
Sure.
Actually, I have read somewhere else that we can write a letter to the bank. I actually forgot the section. We can
37BA rule. Yes, rule
yes.
BA.
So they can deduct in our mother name or father name.
Yes.
So
Actually, it's the right way of doing it, but something what has been done, you can't undo at the time of filing, and hence you would go to AIS and do it. But the right way is actually following the rule 37B and informing the deductor.
that is also a right way, or yeah, this is what we are following is the right way. That is my question in this.
So that's what I'm saying. Today, the banker will not listen to you for last year. So you'll have to go to AIS and say that, look, this is my income, not my child's income, under the child's portal, and respond that it is taken under some
Also,
other PAN.
Madam, there is an issue with the registration on a portal that we are not able to do the minors registration on the income tax website. So we are
Yeah,
unable
income
to
tax-
download the 26AS. All that is also a problem.
So you can file a grievance from the parent's profile, or you can send an email to the CPC, because years ago it was allowable. So thankfully, I don't have right now any minors being registered.
Okay, thank you.
Sure.
There is one more question. It asks us that present 26AS does not contain any details of advance tax or any tax paid through e-payments, from where these payments can be exported in such a way that they need not to be entered manually.
Meaning you will have to do it manually, because AIS and TIS are not there. They are not showing it. So if they're not showing it, you will have to enter it manually by seeing the challans.
So are there any more questions? I don't think there are any further questions. Shivang bhai, would you like to give any closing comments?
I think that should be Jay's prerogative.
Yeah.
But from my side, I would definitely say that it was very, very informative.
Absolutely.
You had so much of clarity in the entire presentation with so much of confidence. So we are very, very obliged. It was great.
Thank you.
So Jay, over to you.
Thank you, sir. First of all, good evening to all of you, and wishing you all very happy Chartered Accountant Day. On this occasion, on behalf of Chartered Accountant Association Ahmedabad, I extend a hearty vote of thanks to our today's learned faculty, Divya Madam, for sparing her valuable time on this day to enlighten us on the ongoing season of ITR filing. Madam, you have explained the various facets and nitty-gritty of ITR forms, including the important topics such as like reporting of income of VDA in ITR form, the detailed explanation of changes in ITR 7 that is related to the trust, reporting of foreign income and how to claim the foreign tax credit in ITR form in a very lucid manner. I must say all the members who are present in this workshop must have been benefited from this session and must have learned the key changes in the income tax return form. At the end, thank you once again, ma'am, for accepting our invitations, and thank you all the members who are attending this webinar and making interactive and knowledge enriching. Thank you. Thank you.
Thank you.
Thank you all.
Request, right? Thank you.
Thank you.
I'm ending the session now.
Yes.
We'll roll out the presentation to every member.
Yes, I will email
Sure,
it
sure,
to you in next 10 minutes.
sure. Thank you.
Thank you. Bye. Bye, everybody.
Okay.
Thank you. Bye,
Thank you.
Shivang. Bye. Bye,
Bye
Utsav.
bye.
Bye, Mayur. Bye.
Bye bye.
Thank you, Jay.